Picture this. It's the late 1970s. Gas prices are soaring, inflation is crushing families, and everyone is convinced the economy is falling apart. The stock market, a ghost town. Most people want nothing to do with it. It's the same kind of fear you've seen recently. But here's the twist. While the majority were running away, a few ordinary people quietly made moves that would end up turning them into millionaires. And what caused that explosion of wealth wasn't luck, it wasn't insider access, and it wasn't being born rich. It was a pattern we're seeing again today. And every time this pattern shows up, it hands a small group of regular people life-changing returns. Welcome back to Stock Predirector. Today I'm going to walk you through exactly what happened the last time we saw this setup in the stock market, why it's repeating almost detail for detail right now, and how everyday investors positioned themselves to turn a few $1,000s into a fortune. Listen closely, because the people who understand this moment, this very moment we're in right now, are the ones who end up on the right side of history. Let's start with something that seems almost too simple: fear. When fear is high, prices drop. Not because companies suddenly become worthless, but because people panic. You've seen this recently. Massive sell-offs, volatility, headlines screaming that everything is going downhill. But here's the thing. Every single market dip in history has had two groups of people. The first panics and sells everything. The second looks at the same environment and sees opportunity. In 1980, Federal Reserve Chair Paul Volcker hiked interest rates to levels we can't even imagine today. Businesses were closing, unemployment was rising, and consumer confidence was basically non-existent. The stock market was beaten down. But a handful of people realized something crucial. Every time rates peak, every time fear peaks, it marks the beginning of a powerful recovery cycle. They bought shares of companies that looked dead in the water, companies like Apple, Walmart, McDonald's, and Ford, because they understood that these weren't dying companies, they were temporarily discounted. When interest rates eventually came back down, those same beaten-down stocks didn't just recover, they exploded. Apple climbed more than 300x in the years that followed. Walmart grew over 100x. And what's wild is that none of the people who capitalized on it were Wall Street professionals. They were teachers, store managers, truck drivers, everyday people who recognized a recurring pattern that most investors overlook. This is important, because the exact same pattern is forming right now. Fast forward to the early 2000s. The dot-com bubble had burst. The Nasdaq dropped nearly 80%. If you think today's corrections are bad, imagine watching almost your entire portfolio disappear. Many investors swore off stocks entirely. But while most were giving up, a smaller group was quietly building positions in companies like Amazon, Netflix, and Adobe, brands that people assumed were finished. Amazon alone fell from over $100 to just $6. And yet, the people who bought at those levels turned every $1,000 into over $250,000 in the years that followed. A $10,000 investment became over $2 million. Let that sink in. Not because they guessed, not because they had special information, but because they recognized the same cycle. Fear had peaked, valuations were historically low, and innovation was accelerating even while the economy looked terrible. This is the part most investors miss. The stock market almost always bottoms out before the economy looks good. By the time the news starts sounding positive, by the time politicians start celebrating improvements, by the time people regain confidence, it's too late. The big money has already been made. Wealth is built during the downturns, not during the peak. That's exactly what we saw in 2009. The great financial crisis crushed the market. People lost jobs, homes, and retirement savings. Most believed the damage would last forever. But the people who bought the dip in companies like Tesla, Nvidia, and Salesforce changed their lives. Tesla traded for $7 adjusted for splits. Nvidia was under $1. Salesforce was under $6. If you held those positions, you weren't just beating the market. You were watching your portfolio turn into generational wealth. And guess what? That same set of signals, rising fear, falling prices, high volatility, and massive innovation brewing under the surface, is happening again today. But this time, the driving force is even bigger. Artificial intelligence, robotics, energy storage, space technology, biotechnology, cloud infrastructure. These sectors are shaping up to be the same types of opportunities that the early internet was in the 90s and 2000s. Think about it. The last time we saw an innovation cycle this big was the birth of the internet. Investors who recognized that shift early made enormous returns without needing a huge amount of money. If you had simply invested $1,500 in Amazon in 2001, it would now be worth hundreds of thousands of dollars. The same pattern is happening again with AI companies and the industries connected to them. But here's the tricky part. This moment doesn't feel like the start of a wealth-building opportunity. It feels scary. It feels risky. It feels uncertain. But that's exactly what it felt like every single time before Millionaires were made. It never feels safe at the bottom. It never feels obvious. If it did, everyone would be rich. Most people wait for confirmation. They wait for the economy to improve, for interest rates to come down, for analysts to give the all clear. But by the time that happens, the stocks that could have delivered massive gains have already taken off. This is why the wealth gap widens after every downturn. One group locks in losses by selling. The other locks in opportunities by buying selectively. And speaking of selective buying, let's talk about the key mistake that wipes out investors: buying everything. The winners in these cycles aren't random. They're always companies that sit at the center of technological or economic transformation. In the 80s and 90s, it was retail, computing, and software. In the 2000s, it was e-commerce and the internet. In the 2010s, it was cloud and mobile. Today, it's AI, semiconductors, energy transition, robotics, automation, and digital infrastructure. Not all companies in these sectors will win, but the ones that do will create the next generation of millionaires. Here's another pattern that repeats every single time. The market punishes winning companies in the early stages of disruption. Nvidia is the perfect example. In 2009, nobody thought GPUs would be useful for anything other than video games. That's why the stock was under $1. Today, Nvidia powers AI systems worldwide and has become one of the most valuable companies on the planet. The people who understood its potential before everyone else are the ones who became wealthy. AI today is where the internet was in 1997. Early, chaotic, full of hype, but also full of opportunity. The companies building the tools, the chips, the data centers, the robots, they're the ones positioned to grow exponentially as adoption skyrockets. And right now, because of economic uncertainty, many of these companies are temporarily discounted. This brings us to the most important question: how did everyday people turn moments like this into generational wealth in the past? Let me break it down simply, because the formula hasn't changed. First, they invested consistently, even when the market was scary. Second, they focused on innovation, not fear. Third, they understood that timing the exact bottom is impossible, so they bought in gradually. Fourth, they held their investments. This is the part most people struggle with. Millionaires are not made by trading rapidly. They're made by identifying future leaders early and sticking with them as they grow. Imagine if someone invested $3,000 into Amazon at $6 during the dot-com crash. That investment alone would now be worth more than many people's retirement accounts. But it only happened because that person held through volatility, held through uncertainty, and believed in long-term innovation. And this is exactly where we are today. You have a choice. Focus on the fear, or focus on the pattern that has created wealth over and over again. Look back through history. Every single crash, correction, or recession was followed by a powerful rally. Not sometimes, not occasionally, every time. The people who bought during those down cycles didn't just make money, they changed their lives. That's why this moment matters. The decisions you make right now, this year, this month, this week, will determine the financial position you're in 5 or 10 years from now. The last time stocks behaved like this, when fear was overwhelming and innovation was accelerating beneath the surface, we saw one of the greatest wealth transfers in modern history. And it didn't go to the elite. It went to normal people who were paying attention. So here's what I want you to think about as we close. Don't let today's headlines scare you out of opportunities that only appear a handful of times in a lifetime. The cycle we've seen repeat for decades is repeating again. The pattern that made everyday people millionaires is showing up again. And the next wave of wealth will go to the people who understand the moment we are living in right now. If you're watching this, you're already ahead of most investors. You're paying attention, you're learning, and you're thinking long-term. And that alone sets you apart from 99% of the market. Thanks for watching Stock Predirector. If you found value in this breakdown, hit that like button, subscribe, and drop a comment telling me which companies or sectors you think will create the next generation of millionaires. Stay smart, stay patient, and I'll see you in the next video.